Hello everyone, thanks for checking out my video. Quick announcement, there won't be a video next week as I will be tied up over the weekend, so I will be back the week after. Anyway, onto the stock market. In the past few weeks, the US stock market seems unfazed by Trump's constantly shifting tariff plans. And interestingly, as this self-inflicted tariff uncertainty slowly clear up over time, the market has been hitting multiple all-time highs over the past 2 months. It looks like Trump's tariffs might just be making the US and even the global stock markets great again. That said, stock markets can't just climb forever without a breather. We had a small pullback and sell-off about 2 weeks ago, and with fresh inflation data coming out this week, could this be another moment for the rally to pause? On a side note, I have picked up some shares of a certain company last week, and I will review which one towards the end of the video, so do stick around and stay throughout, alright? Okay, first up, a quick recap. Most US stocks climbed last Friday, led by a strong rally in the tech sector, helping the major indexes finish the week with solid gains. The tech-heavy Nasdaq even hit a fresh all-time intraday high, powered by Tesla, Google and Apple, each jumping more than 2%. Apple was the biggest winner last week as the share price went up an impressive 13%, its best weekly performance since July 2020. The surge came after the company announced plans to invest roughly $600 billion over the next 4 years in the US, a move that is widely seen as an effort to appease President Trump. Apple's momentum kicked in after Trump announced that he would impose a 100% tariff on imported semiconductors and chips, but with one big exception: companies manufacturing in the US would be exempted. Investors not only viewed this as being less harsh than anticipated, but they also seemed to shrug off Trump's new reciprocal tariffs, which took effect last Thursday. Part of the optimism may be due to recent trade agreements between the US and several major partners, including the European Union. Another possible catalyst that drove last week's rally was the growing bets on the September interest rate cut. Those odds rose after Trump nominated his top economic advisor, Stephen Miron, to fill a vacant seat on the Fed board, amid speculation on who could replace Jerome Powell as the Fed chairman. For context, Miron holds similar views to Trump. He has been vocal that the sweeping US tariffs will not cause a major spike in domestic inflation, as most of the cost burden will fall on overseas suppliers. He is also a strong advocate for rate cuts, even though growth seems to be holding up and inflation is ticking higher. In short, this nomination by Trump is kind of locking in a vote for rate cuts at all the meetings between now and the end of January. The market is now trading with strong expectations of a rate cut. The only question is whether Trump can get the appointment rectified in time for September's meeting. For the upcoming week, the economic calendar gets busier, with fresh data on inflation and consumer health taking center stage. Things kick off on early Tuesday with investors having their attention on the US CPI report for July, which is expected to show the core inflation ticking up to 0.3% from June's 0.2%. Wednesday should be relatively quiet, with the main focus on remarks from a few Fed officials, but the pace picks up again on Thursday, where we get the US PPI. The forecast is that the number will rise 0.2% after being flat in June. On the same day, the market will receive weekly jobless claims report, which I think will unlikely move the market. The week wraps up with a closer look at the American consumer spendings. July retail sales are projected to ease from 0.6% to 0.5%, while the core retail sales are expected to slow to 0.3% from 0.6%. And finally, the preliminary University of Michigan consumer sentiment reading for August will give us some fresh insight into how consumers are feeling and what they expect moving forward. Okay, personally, I believe the upcoming inflation data will put the US stock market rally to test. Some investors are already suggesting that after surging to record highs, the market could be due for a pullback. With inflation having edged higher in June, the key question now is whether it can get back on its longer-term downward trend. So far, tariffs haven't triggered major price spikes, but with more now in place, that could change in the months ahead. Okay, let's now read some charts. First up, SPY, which looks straightforward to me. As you can see, SPY bounced off the first Fibonacci support level after that mini sell-off on 1st August. That's bullish. On top of that, it went on to fill the gap down and did not get rejected. Not just that, it also created higher highs for 5 consecutive days. That's pretty bullish price action. In short, things are looking bullish at the moment. So what's next? Watch that MACD closely this week. If we have a bullish crossover, there is a very high chance that we will test the all-time high at 639.85, which means we could finally see 640's range. From there, a close above 640 means more record highs will be made in the process, because like I always shared, at the so-called uncharted territory, sellers tend to dry up and FOMO investors tend to step in, and that will push the price higher and higher. Alright, on the other hand, for whichever reason, if the market decides to dump, just watch that 23.6 Fibonacci level again. This level is sitting at 624. As long as we stay above this level, the market is still very bullish. Okay, even if we temporarily fall below it, it's still fine. I mean, that was what happened on 1st August anyway. I will only be excited if SPY breaks below the double support level at 615, which is formed by the 38.2 Fibonacci level and the 50 moving average. Alright, moving over to Apple. This part is quite interesting because I want to share 2 additional points. First, I got to admit I was wrong in my analysis last week. I expected Apple to pull back towards the 200 level or even the lower purple line, but that didn't happen. In my last video, I explained how do I tell when I'm wrong, and that is if Apple closes above the top purple line at 214 for several days, my bearish thesis would be invalidated. That's exactly what happened, so I acknowledge it. This brings me to the second point that I want to share. Many investors say that technical analysis is useless or not useful when Trump is in office because his social media posts can suddenly move the market, so why bother reading charts at all? Well, I respectfully disagree, and here's why. I believe those who dismiss technical analysis often don't fully understand how it works. Take Apple as an example. In every technical analysis that I provide, I paint both bearish and bullish scenarios. The way it works is this: if bearish condition A occurs, bearish movement B is likely to follow. Likewise, if bullish condition A happens, bullish movement B could play out. It's an if-then kind of thing. Sounds complicated? Let me further simplify. So in my last video, I said that Apple's chart showed a few bearish signals, which gives it a higher chance of testing the 200 level and possibly moving down to the bottom purple line if 200 breaks. That was my bearish thesis. And then came the announcements from Apple and Trump, and the stock price shot up instead. That means the bearish condition, which is breaking below 200, didn't happen. So I was wrong and I had to be ready to pivot to the bullish side. Sure enough, Apple broke above the top purple line of 214, which I had previously flagged as the bullish trigger. I also mentioned that if Apple goes above 214, a gap fill between 216 and 220 is very likely. And so Apple moved up decisively, closing above 214 with strong green candles and completed the gap fill. So this is how technical analysis works. You prepare for both bearish and bullish scenarios. It is not so much of trying to have a catch-all prediction. In fact, I was clear that my view was bearish last week, and I admitted I was wrong, and I was always ready to switch to the bullish side, which I did. In fact, when I saw the breakout in Apple, I even tried to sell a put option, which is a bullish move as shown on screen, but it didn't get filled because Apple rallied too quickly and I chose not to chase the price. Alright, if you have learned something, you might want to consider supporting the channel in one of the ways listed on screen. I will not go into the details here, feel free to pause the video and check them out. Anyway, what's next from here? At the current level, the next resistance is at around 237. If Apple can close above that, it would be very bullish. We could then see Apple pushing into the high 240s range, approaching the recent high of 250. From here, if it manages to break 250, then it's just a matter of time that we see a new record high. On the flip side, a 12% surge in 1 week is very rare for Apple. As I have mentioned earlier, last week was Apple's best week since July 2020. So while I could be wrong, I do expect some exhaustion in the share price this week. It might test 237 and get rejected, or it could start pulling back from here. I can't predict with certainty, but I do think a brief pause in the rally is likely. If that happens, keep an eye on two key support levels below, the 200-day moving average and the top purple line at 214. I missed the chance to sell a put option last week, so if we see a retracement to these levels and a bounce, I might consider selling a put option again. Oh yes, one more thing, the gap area between 215 and 216 is also a potential support zone. If Apple fills this gap and rebounds, that would be another bullish sign. Moving on to Tesla. Tesla's chart is also looking interesting because it appears bullish but not quite fully bullish yet. Let me explain. In the very short term, Tesla is showing bullish signs after reclaiming the two key 50 and 200 moving averages. It did it in a convincing manner with that 3 solid green candlesticks. In addition, the MACD also saw a bullish crossover. With these signals, there's a chance the momentum could continue this coming week. However, I remain cautious. Here are some key levels to watch. If the bullish momentum persists this week, keep an eye on 332 and the blue downtrend line. The 332 level has acted as a strong resistance in the past, with the price getting rejected on multiple occasions. Next, the blue downtrend line represents a series of lower highs that Tesla has created since late May. So for Tesla to be considered really bullish, it needs to close above both 332 and that downtrend line. Otherwise, this could be just a short-term pop before the price gets rejected at one of those levels. If rejected, Tesla might retest the two key moving averages. A drop below them would mean that the mid-term bearish trend remains intact, possibly pushing Tesla back into the low 300s range. And at that area, watch the 300 psychological level closely. If Tesla breaks and closes below 300, the next target would likely be the green support zone between 285 and 289. Next up, Google. Honestly, I thought Google would test that support level of 188 last week, but it didn't as it stayed above 190 throughout the entire week. Not just that, it even filled up the big gap between 197 and 202. That's obviously bullish. But as the share price moves towards the top end of the channel, I think it's time to be a bit more cautious. Okay, don't get me wrong, I'm not saying it's 100% certain that the share price will pull back from here. Instead, we should pay attention to key levels to see where is the share price heading. First up, watch the top end of the uptrend channel and the psychological level of 200. If Google can close above these two levels for 1 or 2 more days, I think there is a very high probability that we will see new record highs. From there, I don't think you need further analysis from me, because it's the so-called uncharted territory, which means probably more all-time highs. On the other hand, a rejection by the top end of the channel would likely see Google falling below 200 again. From here, it might move to at least the middle of this uptrend channel, which is around 194-195 levels. At this level, there's nothing to worry yet. I will only be slightly excited if Google falls toward the bottom end of the channel and starts testing that support line at 188. By going below this level for a few days would mean that the short-term trend for Google is bearish. Okay, on the flip side, a bounce off this level or a rebound off the bottom of the channel is pretty bullish in my opinion. I will likely step in to sell the put option if we ever get to this area this week or next week. Moving over to Meta, a short one because there's nothing much to analyze for Meta as it basically moved sideways last week. There are only 2 levels to watch this week, which kind of determine the next direction of the share price. So on the upside, watch the all-time high level at 784.75. If Meta closes above it, you know the drill. Sellers dry up, FOMO buyers step in, and the price goes higher and higher till don't know when. And in terms of the downside, watch that huge gap between 708 and 745. Specifically, pay more attention to the bottom of the gap because that is where the first Fibonacci level and the 50 moving averages are. If let's say Meta goes below 708, that means it has broken a double support area or triple support if you want to include the gap as one of the support areas. When that happens, I'm actually expecting Meta to continue its decline towards 680's range. Let's now check out Microsoft chart. Just like Meta, there's nothing significant to highlight. Microsoft basically continues its retracement from the previous week in attempt to fill up the post-earnings gap up. It was almost there, with a tiny gap remaining between 515 and 517. We shouldn't be too surprised or alarmed if it completes the gap fill this coming week. More importantly, we should see if Microsoft can rebound after the gap fill and go above the first Fibonacci support level at 524. A solid close above 524 and staying above it for a couple of days would present a high probability of the share price going close to the all-time high, which is in the 550s range. But I think it's quite unlikely to happen in just 1 week. On the other hand, if Microsoft doesn't bounce off the tiny gap, then we could see the share price moves towards the low 500s range to test the 38.2 Fibonacci level. But all in all, Microsoft needs to fall a lot more before it can get me excited. Minimally, I would want to see Microsoft back to the 50 moving average at around 496. Then I might take some form of action. If there's any changes to this plan, I will update in my videos. Moving on, let's check out Nvidia's chart. Well, it was another week and another all-time high for Nvidia. Just like I have always shared, at all-time highs, investors usually just let the winners run until some major negative event or news come out. Then they will start taking profits, which we will not be able to predict when and what is it. Meanwhile, if we see another all-time high in Nvidia share price again this week, it's kind of expected and we should just enjoy the upside. What makes things interesting is that the MACD seems to want to have a bullish crossover soon. If it happens this or next week, I think we can say hello to the big 190 level. Okay, but if let's say we have a retracement in the share price, I think Nvidia needs to fall a lot before I get excited. Nonetheless, the first support level is none other than the 23.6 Fibonacci level at around 171. If that breaks, naturally, the best target will be to bring it further down to the next support level at 163. If we ever get here these 2 weeks, I might then watch the chart a bit more closely. I would love to have the share price touching or going near the 50 moving average. Anyway, Nvidia is only reporting its earnings in about 2 weeks' time. I think that's the event that could really create a huge movement in its share price. In the meantime, I don't think we will see crazy movements unless of course Trump does some crazy stuff again. Let's now hop over to the options trading section. Just 2 trades to update this week. Both are summarized on the screen. The first trade is this cash secure put on Tesla that was sold last Friday, 8 August. By now you should know that selling a put is a bullish move. So when I step in, it is likely mean that I saw some bullish signals on the chart. So these bullish signals are 3 straight green candlesticks with 2 powerful ones. Then we have the share price reclaiming both the important 50 and 200 moving averages in the span of just 2 days. And finally, the MACD had a bullish crossover. Though the share price got rejected at a heavy resistance level of 332, I think this level could be tested in the near term. And there is also some probability that we could test the blue downtrend line. This means in the near term, there is still a bit more juice for Tesla to go up. The second trade to update is this cash secure put on Google, which expired last Friday, 8 August. The contract was sold on 1st July with a strike price of 160. The reason for making this trade back then was pretty simple. As you can see on the chart prior to 1st July, despite falling out of the uptrend channel, Google rebounded off the 50 moving average and quickly went back into the channel. At the same time, it also reclaimed the 200 moving average, with the MACD about to have a bullish crossover. These were bullish signals for me to step in, and so I did. Since I sold the put option, Google has never gone below 170 at all, and my 160 strike price was never in danger of getting breached. As of last Friday, Google closed above 200 and my contract expired worthless. The profit for this trade is about $260. Okay, sharing some of my current thoughts. The market's reaction to Trump's latest tariffs is a sharp contrast to the steep sell-off we saw in April. Back then, stocks tanked. The S&P 500 even fell into the correction territory after its biggest single-day drop since 2020. Fast forward to now, and it's almost ironic. Trump's tariffs seem to be making the US stock market great again, at least in the short term. Trump claimed that tariffs are having a huge positive impact on the stock market, and almost every day, new records are set. Well, he's not wrong per se. Since its April lows, the S&P 500 has surged 28% as fears of a tariff-driven recession eased. Investors appear to believe that Trump won't push its most aggressive tariff threats to the extreme. The funny thing is, Trump even warned the US courts against overturning his tariff policies, saying that doing so would cause 1929 all over again, a Great Depression. Anyway, this whole optimism surrounding Trump's tariffs and interest rate cut could be tested if the upcoming CPI data comes in hotter than expected, which could make the Fed more hesitant to cut rates. If CPI suggests that the market got ahead of itself, volatility may spike and pullbacks will come. Okay, to be fair, the impact of these tariffs has been less severe than many anticipated, but I also want to remind everyone while the overall tariffs are lower than the feared levels from April, they are still at the highest point in at least a century. As I have mentioned several times, the economic effects of these tariffs may take some time to fully materialize. My view is that the market might be getting ahead of itself. For example, although the tariffs on the European Union are lower than the feared 50%, the current 15% tariff could still have a significant impact on the economy. And that's the vulnerability in the market. It is focusing too much on the good news, which is not getting the 50%. But the problem is, getting that 15% is actually still not a good thing. At some point, it is going to show up in the economic data, unless of course Trump changes his mind again. One last thing to note, I know past results do not represent future performances and that this year could be different, but I think we should still remain cautious about seasonality risk. Historically, August and September are the weakest months for the S&P 500. A mix of softer labour market and tariff-driven inflation fears are some of the potential headwinds for a market pullback in the next 6 to 7 weeks. With all that being said, I remain optimistic. More precisely, cautiously optimistic. And I plan to buy the dip whenever there is a meaningful pullback. Speaking of this, I picked up some Salesforce shares last week. But just to be clear, this is not financial advice, alright? Also, I know I mentioned a potential pullback in my past 1 or 2 videos. To clarify, I'm not trying to say this every single week until a pullback finally happens and claim I was right. What I really want to emphasize is a reminder for the viewers. While we enjoy these green days and the market rally, it is important to stay grounded and avoid complacency. That's a message and reminder that I am also giving myself. Okay, that's all for this video. If you found my free content useful, do help me with the YouTube algorithm by tapping the like button and comment something below. Thank you very much.